Welcome to The Explainer. Today, we are completely stripping away the political headlines and running two incredibly hyped alternative platforms, Rumble and Public Square, through the ultimate financial X-ray. We're going to apply the classic valuation lenses of legends like Warren Buffett, Peter Lynch, and Benjamin Graham to see if the raw SEC data actually reveals a true margin of safety or if it's all just an expensive narrative. So what's really driving these alternative platforms? To find the answer, we have to tune out all that constant noise surrounding these brands. Instead, we're focusing strictly on discovering their true underlying intrinsic value. Whether you follow these companies religiously or you're just hearing about them for the first time, the financial structures they use to scale, wow, they are incredibly revealing. Just take a look at this staggering number. $13.7 billion. That is a massive figure. It represents Rumble's recently announced 6-year contract to supply AI chips and GPU services to an unnamed cloud customer. Now, that headline immediately sent their stock jumping in the pre-market, but a number that big, it requires some serious infrastructure and massive capital expenditure to actually fulfill. And that perfectly sets the stage for a critical look at their cash flows. Okay, here is our roadmap for today. We'll start by going beyond the headlines, then look at the financials under the hood. Figure out who really holds power, examine the risks and roadblocks, and finally wrap up with market position and outlook. Let's get right into it. First up, Section 1, Beyond the Headlines. We are exploring the massive growth numbers. You know, the sheer velocity of the top-line revenue growth here is absolutely undeniable. Peter Lynch would almost certainly categorize these guys as fast growers. Rumble posted second quarter sales of over $40 million. That's a huge 60.9% year-over-year jump. And meanwhile, PSQ Holdings leaped from under $500,000 in 2022 to over $5.6 million in 2023. They are capturing users so rapidly and driving some truly impressive sales momentum. Moving on to Section 2, Financials Under the Hood. Let's talk about the reality of all this rapid growth. So while Rumble definitely beat revenue estimates, their bottom line tells a bit of a cautionary tale, especially if you're building a DCF valuation. Their GAAP loss widened, but the critical figure we need to look at is free cash flow. It's sitting at a negative $91.6 million just for the quarter. When you're forecasting free cash flows for a DCF model, a cash burn accelerating at that kind of pace, it severely punishes your terminal value. And PSQ Holdings, well, they're facing a very similar dynamic. Benjamin Graham's defensive investor checklist practically demands a strong financial condition. But PSQ's 2023 balance sheet reveals a growing accumulated deficit topping $62.2 million. That is up massively from just $8.8 million the year prior, completely overshadowing those impressive revenue leaps we just talked about. The stark contrast here between skyrocketing user growth and a seriously heavy cash burn is the defining characteristic of both these platforms right now. Look, building huge ecosystems in AI or direct-to-consumer e-commerce requires an immense amount of capital. So for the value investor, the absolutely crucial question becomes, are they building a true economic moat, or is this just a massive money pit? That brings us to Section 3, Who really holds power? Let's dive into corporate governance and voting rights. Okay, this is super important. Both Rumble and PSQ Holdings operate as what's known as controlled companies. Basically, this means typical retail investors have significantly less influence over the board than the original founders do. If we think about Warren Buffett's principles of honest management and owner alignment, minority shareholders here are essentially just along for the ride without a steering wheel. To put this into perspective, thanks to a multi-class share structure featuring these super voting Class D shares, Rumble CEO Chris Pavlovski controls roughly 83% of the voting power. So when you buy a standard Class A share of Rumble, you aren't really buying any influence over the board. Instead, you're betting entirely on the founder's vision and their specific capital allocation skills. Additionally, PSQ utilizes the emerging growth company exemption. Sure, it saves them a ton in compliance costs early on, but it poses a pretty unique risk for the meticulous analyst. Lighter regulatory rules and way less granular historical data make it significantly harder for us to calculate Benjamin Graham's exact intrinsic value, or really to pin down a precise return on equity. All right, Section 4, Risks and Roadblocks. Let's look at what the SEC filings actually reveal. For PS2 Holdings, their recent acquisition of the consumer finance platform Credova introduces some really heavy scrutiny from the highly competitive buy now, pay later sector. When you're analyzing this space, keep in mind that a low barrier to entry directly threatens any potential economic moat. It literally means new competitors can constantly jump in and erode those profit margins. In fact, PSQ's own 10K filing explicitly warns that new consumer protection regulations could make it economically unfeasible to even continue their buy now, pay later segment. It's definitely a calculated growth risk to expand their marketplace this way, but it's one with severe regulatory exposure that genuinely threatens their future earnings consistency. Meanwhile, Rumble has its own operational hurdles to clear. Remember that massive $13.7 billion AI contract? Well, to actually build out the infrastructure required for that, they're likely going to need to pursue further debt or equity financing. And here's the catch: funding this through equity destroys shareholder value via dilution. On the flip side, taking on expensive debt increases their weighted average cost of capital, which drags right down on their DCF fair value. And finally, Section 5, Market Position and Outlook. Where do they go from here? I think Benjamin Graham would look at this stock volatility and see Mr. Market at his absolute most erratic. Think about it. Rumble has seen dozens of massive daily price swings and is up 52% year to date. Yet, if you had put a $1,000 investment in exactly 5 years ago, it would actually be worth slightly less today. The market absolutely loves short-term revenue beats, but long-term value ultimately demands a real pivot to sustained profitability. Now, to reach that much-needed profitability, PSQ is relying heavily on an asset-light model. By using third-party manufacturers for their direct-to-consumer e-commerce brands, they are desperately trying to avoid those heavy capital expenditures. Frankly, their long-term survival hinges entirely on executing this strategy successfully before they completely exhaust their existing cash reserves. So I'll leave you with this to chew on. We've seen the explosive top-line growth, for sure, but we've also mapped out the huge cash burn, the highly concentrated voting power, and those lurking dilution risks. If we strictly apply the legendary lenses of Buffett, Lynch, and Graham, the margin of safety here is incredibly thin. Are investors buying a sustainable business model currently trading below its intrinsic value? Or are they simply overpaying for an exciting narrative? Keep asking those hard questions, and thanks so much for joining me on this explainer.